Nothing is crashing. The economy is still running, jobs exist, prices are high, credit is still flowing. And yet, something underneath is changing. Fewer people are keeping up. More households are leaning on credit just to stay in place, and risk, instead of disappearing, is quietly sinking across the system. This isn't 2008, but the system is under pressure in a way most people aren't looking for. Subprime auto is not the problem, it's the symptom. Over the past few months, a familiar narrative has taken hold. A subprime auto lender collapses. Another reports rising delinquencies. Repossession rates begin to climb, and almost immediately the explanation follows. This is an auto loan problem, or worse, this is a borrower problem. People borrowed too much. They chose the wrong cars. They made bad financial decisions. But that explanation is comforting precisely because it's incomplete. Because in modern financial systems, crises rarely begin where the real damage ultimately appears. They begin at the margins, in the weakest, least protected corners of the market. Subprime auto lending isn't dangerous because of its size. It's dangerous because of its position. It sits at the very edge of consumer credit, where income volatility shows up first, where payment stress appears earliest, and where small changes in cash flow have outsized consequences. That's why subprime auto almost always breaks before anything else. Not because cars matter more than homes or credit cards, but because subprime auto is where financial strain becomes visible before it becomes undeniable. History makes this clear. Before broader credit markets reprice risk, defaults rise among the weakest borrowers. Before balance sheets crack, the margins thin. And before confidence breaks, the least resilient loans begin to fail. This isn't an anomaly. It's a feature of how credit cycles work. Subprime auto doesn't create systemic risk, it reveals it. And when stress appears there, it's rarely contained. In isolation, a single lender failing would be unremarkable. Financial history is full of poorly run firms that took excessive risk and paid the price. But what matters isn't the failure itself, it's the pattern behind it. Are defaults rising across multiple lenders? Are newer loan vintages performing worse than expected? Are losses emerging faster than models assumed? When the answer to those questions starts shifting from no to maybe, something more structural is happening. Because truly isolated failures don't line up in time. They don't cluster, and they don't appear simultaneously across different balance sheets. Yet that's exactly what we're beginning to see. Delinquencies creeping higher among the riskiest borrowers, loss assumptions being quietly revised, and early pressure building in parts of the credit system designed to absorb stress. This doesn't mean the system is on the verge of collapse. It doesn't mean we're repeating 2008. And it doesn't mean every loan is about to fail. What it does mean is that the assumptions holding the system together are being tested. And once assumptions start breaking, they rarely break in only one place. Subprime auto is not the disease, it's the symptom. A warning light, not on the dashboard, but under the hood. And in the chapters ahead, we're going to follow that warning beyond auto loans, into credit cards, into buy now, pay later, and into the structure that connects them all. Because this time, subprime isn't hiding in one corner of the market. It's embedded across the entire consumer credit system. But to understand why that symptom matters, we have to stop looking at markets and start looking at the borrower behind them. The same borrower is behind everything. When we talk about subprime risk, it's easy to picture separate markets. Auto loans over here, credit cards over there. Buy now, pay later somewhere else entirely. Different products, different lenders, different risk profiles.
But that separation exists mostly on paper. In the real economy, these aren't independent systems. They're different entry points into the same household balance sheet. The same borrower sits behind all of them. A typical household doesn't experience financial stress one loan at a time. Stress shows up in cash flow, and then it spreads. A missed shift at work, a reduction in hours, a medical bill, higher rent, higher insurance, higher food prices. Individually, none of these are catastrophic, but together they begin to compress the margin that keeps everything functioning. At first, the household adjusts. They delay discretionary spending. They lean more heavily on revolving credit. They stretch payments where they can. This is where credit cards step in. Balances rise. Minimum payments get made. Utilization climbs. On paper, nothing looks broken yet, but underneath, flexibility is disappearing.
Auto loans usually come next. Car payments aren't optional. They're tied to employment itself, getting to work, keeping income flowing, so households prioritize them as long as possible. That's why auto delinquencies tend to lag other forms of stress. But once they start rising, it's rarely because the borrowers suddenly became irresponsible. It's because there's nowhere left to adjust. And then there's buy now, pay later. BNPL, buy now, pay later, isn't the first line of credit. It's the last. It appears when credit cards are already near their limits, when savings are gone, when the budget has no slack left. Groceries, utilities, basic household goods, these aren't luxury purchases, they're survival spending. So when BNPL starts to break down, it tells us something critical. Not that borrowers are overextending, but that they've already exhausted every other option. This is why defaults don't stay contained. A household doesn't default on an auto loan in isolation. They don't max out a credit card without pressure elsewhere.
And they don't miss BNPL payments unless the entire cash flow picture is already strained. These products may look separate to lenders and investors, but to the borrower, they're one system. One monthly income, one set of bills, one shrinking margin for error. And that's the mistake the financial system keeps making. It models these risks as if they're independent, as if stress in one corner won't spill into another. But when income weakens, all of these obligations are exposed at once. Not immediately, not evenly, but inevitably. That's why rising stress in subprime auto matters beyond auto loans. It's not a signal about cars, it's a signal about households. And once enough households begin feeling the same pressure at the same time, the problem stops being individual behavior. It becomes a systemic question. In the next chapter, we're going to look at why that simultaneous stress matters so much, and why financial systems are far more vulnerable to when defaults happen than how many occur. Because risk doesn't become dangerous when it's large, it becomes dangerous when it's synchronized. It becomes a systemic question. And once you realize it's the same borrower behind every loan, the real risk isn't how many people default, it's when they default together.
Why defaults don't happen one by one. In finance, there's a common misunderstanding about risk. Most people assume risk grows linearly. More bad loans means more losses. Fewer bad loans means less danger. But that's not how financial systems actually break. They don't fail because defaults increase. They fail because defaults synchronize. In healthy economic conditions, financial stress is scattered. One borrower loses a job. Another falls behind on payments. Someone else defaults, but slowly and in isolation. Losses are absorbed. Buffers work. The system holds. This is the environment most credit models are built for. Low stress, low overlap, low correlation. But when economic conditions weaken, the pattern changes. People don't struggle independently anymore. They struggle together. Hours get cut across entire industries. Layoffs hit clusters of workers at once. Costs rise everywhere at the same time, and suddenly defaults don't arrive one by one. They arrive in waves. This is what correlation really means. Not a technical statistic, not a formula, but the simple reality that financial stress tends to concentrate. When income weakens broadly, many borrowers cross their breaking point at roughly the same time. And that's the scenario financial systems are least prepared for, because credit markets aren't designed to absorb synchronized failure. They're designed to absorb randomness. This distinction matters more than almost anything else in finance. A system can survive a large number of isolated defaults. It struggles when a smaller number of defaults arrive together. That's because modern credit isn't held loan by loan. It's pooled, packaged, and priced on assumptions about independence. As long as defaults are scattered, those assumptions hold. But when correlation rises, the math changes. Losses don't just increase, they compound. And the timing becomes as important as the magnitude. This is why early stress in subprime auto is so important. Not because the losses are large, but because they're happening at the same time, across multiple lenders, across similar borrower profiles, across recent loan vintages. That clustering is the signal. It suggests that the pressure households are under isn't isolated or temporary, it's systemic. And once defaults begin clustering in one segment of consumer credit, they rarely stay contained.
Because the same forces that cause auto loans to fail, compressed income, exhausted savings, rising fixed costs, are acting on credit cards and buy now, pay later at the same time. Correlation doesn't mean everything collapses instantly. It means the margin for error disappears faster than models expect. And when that margin disappears, markets don't adjust smoothly. They reprice suddenly. Risk that was assumed to be close to zero becomes non-zero. Assets that were treated as safe are questioned, and confidence begins to thin. This doesn't require a crisis. It doesn't require panic. It only requires assumptions to change. And correlation is the assumption everything else rests on. In the next chapter, we're going to look at how this synchronized risk spreads through the financial system, not through borrowers, but through securitization and the structures that turn everyday consumer loans into assets the entire system depends on. Because once correlation rises, the problem is no longer who borrowed too much, it's how risk was priced in the first place. Once risk becomes synchronized, it doesn't stay with the borrower. It moves into the financial structures built on top of those loans.
How subprime spread through securitization. When people think about financial contagion, they usually imagine it spreading from borrower to borrower. But that's not how modern credit systems transmit risk. Risk spreads through structure. Most consumer loans don't stay on the balance sheet of the lender that originated them. Auto loans, credit card receivables, buy now, pay later installments. They're pooled together, sliced into securities, and sold into the financial system. This process is called securitization. At its core, securitization is designed to do one thing: turn illiquid, risky loans into liquid, tradable assets. And under normal conditions, it works. Loans are grouped together, cash flows are prioritized, losses are absorbed in layers. The riskiest pieces take the first hit. The safer pieces are protected. On paper, this makes the system more resilient. But that resilience depends on one assumption: that defaults are scattered. As long as losses arrive slowly and independently, the structure holds. But when correlation rises, securitization doesn't eliminate risk. It concentrates it. Because securitization doesn't remove risk from the system, it redistributes it. Junior tranches are designed to fail first. That's expected. But senior tranches are priced as if failure is almost impossible. They're treated as stable, reliable, often used as collateral. That's where the problem begins. When defaults start clustering, losses move through the structure faster than expected. Junior tranches are wiped out, mezzanine layers thin rapidly, and suddenly the question shifts. Not, are there defaults, but are there more defaults than the structure was built to handle?
This is where synchronized risk becomes systemic risk. Because once senior tranches are questioned, the impact goes far beyond the original loans. These securities don't just sit in portfolios. They're pledged, they're financed, they're reused, especially in the repo market. When senior asset-backed securities are accepted as collateral, they support borrowing throughout the financial system. They provide liquidity. They anchor balance sheets. But that only works as long as their risk is treated as negligible. When correlation rises, that assumption weakens. Haircuts increase. Financing tightens. Liquidity evaporates. Not because losses have already occurred, but because the possibility of losses has increased. This is why repricing happens suddenly. Markets don't wait for defaults to fully materialize. They react to changes in assumptions. And correlation is the assumption everything else is built on. Subprime auto, credit cards, and BNPL don't create systemic risk on their own. But when they're securitized, and when the same borrower stress shows up across all of them at once, they become part of a single, fragile structure. A structure that looks stable until it isn't. In the next chapter, we're going to look at the newest and least tested part of this system, buy now, pay later. Because BNPL doesn't just reflect financial stress, it often marks the point where stress has already gone too far. Until it isn't. And when a credit system stretches this far, the next place stress shows up isn't at the top of the structure, it's at the very end of the consumer's balance sheet. Buy now, pay later is the new subprime frontier. Buy now, pay later was marketed as something different, a smarter way to spend, a more flexible alternative to credit cards, a tool for responsible budgeting. And for a while, it worked. Small purchases, short repayment windows, low or zero interest. On the surface, BNPL looked safer. But what matters in credit isn't how a product is marketed, it's when borrowers turn to it. BNPL is rarely the first line of credit. It appears after savings are gone, after credit card balances are already high, after monthly cash flow has been stretched thin. In other words, BNPL sits at the end of the credit line. That position matters, because by the time borrowers rely on BNPL for everyday expenses, groceries, utilities, basic household goods, flexibility is already gone. There's no more room to adjust, no buffer left to absorb shocks. This is why BNPL deserves attention, not because it's large, not because it's exotic, but because it reveals the final stage of consumer financial stress. Unlike traditional credit cards, BNPL often bypasses deep credit checks. Approval is fast, friction is low, decisions are made in seconds. That makes BNPL accessible, but it also makes it vulnerable. When income weakens, BNPL doesn't fail gradually, it fails abruptly. Payments are missed within weeks, accounts stack up quickly, and defaults surface faster than in longer-term loans. This doesn't mean BNPL is poorly designed. It means it's designed for stability, not stress.
And when stress becomes widespread, BNPL acts like a pressure gauge. It doesn't cause the problem, it measures it. What makes this more concerning is how BNPL fits into the broader credit system. Many BNPL loans don't stay with the original provider. They're funded, packaged, and increasingly securitized, which means the same dynamics we saw in auto loans and credit cards apply here too. When borrower stress is isolated, BNPL losses are manageable. But when stress is synchronized, when the same households are struggling across all forms of credit, BNPL doesn't remain a niche issue. It becomes part of the same correlation problem.
Defaults cluster, loss assumptions break, and risk that looked contained begins to travel. BNPL isn't the next crisis, but it is a signal that households are relying on credit not to smooth spending, but to sustain it. And once credit shifts from convenience to necessity, the system is no longer operating the way it was designed to. In the final chapter, we're going to step back and put all of this into context. Why this isn't 2008, why it still matters, and what happens when a system built on low correlation has to adjust to a very different reality. The system is no longer operating the way it was designed to. Taken together, these signals don't point to an imminent collapse, but they do point to a system operating under very different conditions than before.
This isn't 2008, but it's not stable either. Every financial crisis has a pattern, but no two crises are identical. 2008 was a collapse driven by leverage, opacity, and a housing market built on fragile assumptions. This is different. Banks are better capitalized. Mortgage underwriting is tighter. Household balance sheets, on average, are stronger. There is no single asset class imploding under its own weight, and that matters. But stability isn't just about avoiding collapse. It's about how systems behave under pressure. What we're seeing now isn't a break, it's a distortion. Asset prices remain high, economic activity continues, credit still flows. But beneath that surface, the system is adjusting to a world it wasn't built for. Higher rates, persistent inflation, slower income growth, a world where carrying debt is no longer cheap. In this environment, risk doesn't explode all at once, it accumulates. It shows up in pockets, in patterns, in correlation. The danger isn't that everything fails, it's that everything weakens together. When households rely on multiple forms of credit to maintain the same standard of living, resilience shrinks. When defaults begin to cluster across auto loans, credit cards, and BNPL, diversification loses power. When securitized products are priced for independence but experience synchronization, assumptions quietly break.
None of this guarantees a crisis, but it does change how fragile the system becomes. The most important lesson from 2008 wasn't about housing. It was about mispriced risk, about structures built for one environment being forced to operate in another. That's the parallel worth paying attention to. Not panic, not prediction, but alignment. Because systems don't fail when conditions change. They fail when assumptions don't. And right now, many of the assumptions underlying consumer credit were formed in a world of low rates, abundant liquidity, and stable correlations. That world no longer exists. The adjustment won't be loud. It won't look like a crash. It will look like pressure. Tighter lending, higher rejection rates, less margin for error. For households, for lenders, for markets. This isn't the end of the system, but it is a reminder that stability isn't permanent, that risk doesn't disappear, and that the most important shifts often happen quietly, long before headlines catch up. If you found this breakdown useful, it helps the channel when you subscribe so more people can find work like this. And if you disagree or see something I missed, the comments are open. Thanks for watching. I'll see you in the next one.